Lesson 5, Trends and Trend Lines. Before we get started, I'd like to point out a couple things. Number one, at the very bottom center of this page, you'll see a number. That is the number of the slide that comes up as I click forward. In your workbook, that same number is there. If by chance you get lost along the way and you don't know what slide we're on, just look at that number and compare it to the number in your workbook. The second thing I'd like to point out is up in the top left-hand corner, I have a sign that says important information. You will see this sign appear on certain slides and in your workbook. Whenever you see that sign, that information that's on that page is real critical, and it really is somewhat of a trader's tip that can participate in helping you become a better trader. I would also like you to take the time to please read this so you that understand what trading is about. There are 16 lessons on trading the Forex. They focus in on technical analysis. Technical analysis is the study of chart reading that can participate greatly in helping you. We focus in on the Forex. A lot of the exercises in here are on the Forex. However, there are some exercises on stock charts as well, because technical analysis is applicable to all charts. I heard this statement a long time ago: successful traders will do what unsuccessful traders can't and won't do. Now, if you really think about it, the only difference between you and a very successful trader is they know and can do something that you can't do. However, what they do and what they know, you can learn to do. Change the word traders to people. Successful people will do what unsuccessful people can't and won't do. I've learned in my experience and in my business career and in my trading career that success is a habit. Success is a discipline. Success is something you learn, and then you become disciplined at being successful on a daily basis. You are successful because of your disciplined habit that you learn. Learning to trade will become a discipline. It will become a technique that you will learn to execute, and you will need to be disciplined in executing that technique. There is a 21-day 3% rule. What does that mean? It means that the human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. Take this CD or video and re-watch it over and over and over again until you understand what you need to know on how to trade trends and trend lines. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. That's all they can do. You will learn how to read a trending trading chart and be introduced to the technical side of dealing with a trend. You will learn how to find and draw 3 trend lines: the inner, the outer, and a long-term trend line in an uptrend as well as a downtrend. You will learn how to find a trade in an up or down trend, create a trading plan, and financially protect yourself in every trade. You will learn how to spot the end of a trend. Before we get started, let's review reading a trading chart and placing orders. We watch Japanese candlesticks. They monitor the open, the high, the low, and the close of a time period. They're bullish candles and bearish candles. Bullish candles signify hollow candles or white candles. They go up. Bearish candles signify candles that are going down. The market is going down in price. They are the black candles. The market doesn't go up and it doesn't go down. It is constantly going up and down, constantly on the move. We are also watching a bid chart. The prices that you see, the current price, that is the bid chart. There is a bid and an ask. The ask is usually 3 to 10 pips higher than the actual bid chart. If I was to have an ask chart up here, it would look identical to this candlestick chart. It would only be 3 to 10 pips higher than this bid chart. The difference between the bid and the ask is called a spread. Trade products with tight spreads. Do not trade products that have huge spreads. A lot of people think that trading penny stocks is just easy because the stock only costs a penny or a nickel. Sometimes the spreads are 100% on penny stocks. You buy a stock for 10 cents and you want to sell it, and they're only offering 5 cents to buy it. So the bid and the ask can be as much as 100%. The ask is 10 cents, the bid is a nickel. So spreads are very important. In the currency market, there's 3 to 10 pip spreads. If you don't understand this, please feel free to call our customer service line and we'll explain that to you in detail. We buy on the ask and we sell on the bid. So keep that in mind. We're always buying on the ask and selling on the bid. The ask price will always be higher than the bid price. Envision an auction. When we're at an auction, the ask price, we're always asking more. If I was selling a pin and asking $10 for it, you would probably bid $5. That difference is called the spread between $5 and $10. That's the spread. But see how the ask price is higher than the bid? Keep that in mind. So when you're buying, we buy on the ask, which means if this is the bid price and that's the current price, if I was buying at the market, I would be buying at 107.35 because I'm buying on the ask. The ask is about 5 pips higher. So when I place my sell limits, I would be selling on the bid. Whenever the market rallied and the candlestick hit that price, that's the bid price. Or if the market fell and hit my stop order, whatever number was there, since I'm selling on the bid, when this candlestick hit that price, my order would be executed or filled. Conversely, I sell on the bid. So if I'm selling and entering the market at the market right now, I'm selling right now at 107.30. That's the bid price. If the market rallies and goes up to here and I have my stop order at this last high, the ask price will hit that stop order way before the bid price will. And many traders get confused. Whenever the market rallies, they see that the candlestick did not hit their stop order, and then the market rallies, comes up, U-turns and falls. The trader's sitting there glad that they weren't stopped out, yet the ask price hit it and they were stopped out. Please understand this to avoid a lot of confusion. The same applies on when you buy below the market. It's a limit order and you buy on the ask. So keep that in mind. Types of orders: we deal with a market order, which is an order at the market. We deal with a limit order, which is an order above the market or below the market you can place, and a stop order. These are orders that are placed at specified prices. If you have any questions about these, please give our company a call or review in detail Lesson 1, which goes into detail about the market, limit, and stop order. Whenever you buy above the market, that is a stop order. When you sell above the market, that is a limit order. When you buy below the market, that's a limit order. When you sell below the market, that's a stop order. If the market is here, any order you place above the market is called a working or open order. It's an order that's not filled. Any order you place below the market is an open or working order, an order that's not filled. These are the rules of trading. You just got to understand them. Ordering rules: for every buy, you need to have 2 sells, one for protective loss stop and one for profit. Let's just say the market here has broken the trend line. You enter the market's sitting in the buy zone. A great lesson on buy and sell zones is Lesson 6. You place your order at your stop order at the last low. Market You enter the market buying on the ask. You place your stop order, last low, market continues to rally, there's your profit. You have a buy with 2 sells. Conversely, every sell should have 2 buys. Whenever you're selling or shorting the market, you want the market to go down, you're a bear, your position is short, you're trying to profit as the market is dipping and falling. You need a buy order for profit. When you buy below the market, it's a limit order. When you buy above the market, it's a stop order. These are the rules of trading. Let's look at this chart. Market breaks the trend line, enters into the sell zone. You enter the market. At the market, you sell on the bid. You place your stop order at the last high, and then the market falls. For every sell, you need 2 buy orders, your buy stop loss order and your buy limit order. So OCOs are an order where you can set it and forget it. You find for whatever reason, let's just say you're looking at stochastics, PCI, a trading indicator for that matter, and it gives you a buy signal. You enter the market buying. Whenever you place an order to buy, every buy should have 2 sells. You place an order to sell for profit, an order to sell for potential loss. You can set it and forget it. Whichever the market hits first, it will cancel the other order. OCO, one cancels the other. Cancel and replacing. Please go to lesson 3 on equity management as well as lesson 16. It teaches you how to properly cancel and replace, but if you were to enter buying the market and you wanted to chase the market, your stop order would be at the last low as the market rallied. Do not cancel and replace your order to the last low until the market has taken out the new high. So if you were to cancel or replace your order from here up to here, you cannot do that until it has reached here. So as the market retraces back, creates a low, and rallies, takes out the previous high, now it's time to move from here to here. Market retraces, establishes a low. At this point in time, when it takes out this high, is when you can move your protective stop loss order from here to here. As the market retraces back a little bit, U-turns, takes out the high, now you can move it from here to here. As the market rallies, retraces back, and U-turns and takes out the high, now you can move it from here to here. The same applies in a downtrend. Do not cancel and replace until the market has taken out the new low. So only cancel and replace to the new last high after the market has made a new low. You enter the market here, your stop order is there. You can cancel and replace to this high when the market takes out this low. So you would go from here to here. As the market bounces here, U-turns, takes out the low. Now you can go from here to here. As the market comes down, takes out that high, or bounces, U-turns, takes out the low. Now you can replace it from here to here. Keep trading, canceling, replacing, locking in profit until you've been stopped out. This is not a greedy way to trade. This is a very educated way to trade. Bulls want the market to go up, and bulls buy low and sell high. So for whatever reason, in this shot here, there's a trading indicator that is giving off buy and sell signals. Bulls buy low, sell high, buy low, sell high, buy low, sell high. Bears do the opposite. They sell high and buy low. Now think about it. A bear thinks the market's going to fall. The greatest part about trading currencies is whether the market is rallying or reacting or falling, you can make money. Once you learn how to short the market, you can make money by selling first and buying second. Now, if you sell first and the market falls and you buy second, did you buy low and sell high? Yes. If you don't understand how to short the market, feel free to call us. We'll explain it to you in detail or review lesson 1. It focuses in on shorting the market and explaining. Once again, if you sell a product for $107 but you bought it for $104, did you make any money? Yes, you did. You made $3. So Learn how to short the market. It offers great potential in the currency market. Technical traders learn to read charts. They read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. So the education is well worth it. A chart is a chart is a chart. Technical analysis is applicable to all markets and anywhere you can pull up a chart. Once you've been educated on how to read a chart, you will start to control your financial future. This lesson requires a review of support and resistance. Remember that a high is 2 to the left, 2 to the right. You have 2 candles to the left that are lower than the either candle or wick high, and 2 candles to the right that are lower. Remember that not all highs are levels of resistance. Only higher highs that are being created are new levels of resistance from where the market is currently trading. Lesson 2 goes into detail about this. Lows have 2 candles to the left and 2 candles to the right that are higher than the wick or body of the candle low. That signifies a low. Not all lows are levels of support. Once again, please refer to lesson 2 to understand support and resistance. Be that as it may, here's where the market is. One of the things you need to get in the habit of doing is, before you trade, go and find all your levels of resistance first, all your levels of support, because this is a financial game. Whoever takes control of the market, the bulls, if they take control, they are going to try to achieve new highs. These levels of resistance become milestones. They are going to try to take them out, meaning they'll try to rally and make a new high and take out resistance 1, resistance 2, resistance 3, resistance 4. Conversely, if the bears take control, their milestones are support 1, support 2, support 3. They'll probably take this market and take it down and take out all levels of support. That is the financial game. So don't underestimate that game. The best way to understand what you've learned is to write down what you think you know. Then go back after you have been taught and look at what you have been taught and now what you know versus what you thought you knew. Your perception is your reality. Write down what you see and think you know about trend lines. Now you can clearly pause your machine and go ahead and try to find what's called inner, outer, and long-term trend lines. And then we'll see what you know at the end of this lesson. Draw your inner, outer, and long-term trend lines. This is a daily chart. Trend lines are applicable on all charts. This is a Japanese 4-hour chart. Pause your machine and draw the line. This is a Euro 1-hour chart. Pause your machine and draw your trend lines. This is Microsoft. It's a 2-hour chart. I've used a variety of charts just to show you that trend lines are applicable in all charts. This is a stock. Pause your machine and draw your 3 trend lines. This is Dell stock. Pause your machine and draw your 3 trend lines. Let's get started. Trends and trend lines. An uptrend. Well, it all begins with a price swing. As the market moves, it waves. And those waves are called price swings. Uptrend price swings start at the low and stop at the high. They start down here and stop at a high. Whenever you now have a confirmed low, that's the beginning, and a confirmed high to the left, to the right, that's the stop. Let's look at this. This is a up price swing. Look at how 2 to the left, 2 to the right, 2 to the left, 2 to the right. It comes down, finishes off with a tweezer bottom. Lesson 11. really focuses in on trading candlesticks. It's a great lesson. Creates a tweezer bottom here and ends the swing. Another one starts up. So uptrends. Uptrends is when the chart is establishing higher highs and higher lows via price swings. Look at this. See how this high is higher than this high, and this high is higher than that high, and this low is higher than that low, and this low is higher than that low. Let's look at this chart. See how it's making higher highs and higher lows? See how this low is higher than that low, and that low is higher than that low? Higher highs and higher lows is called an uptrend. This is another chart making higher highs and higher lows. This is another chart making higher highs and higher lows. This is what an uptrend looks like with an indicator. See these indicators giving off buy and sell signals? Please go to lesson 4 on trading indicators. Market Traders has some great indicators as well. Keep in touch with us. We will teach you the latest indicators on our software. They can be very helpful. This indicator showed you to get in here that this downtrend was reversing, and now a new uptrend here became the buy. Look at all this profit being made via this indicator. When you spot an uptrend, you will draw your trend lines across the lows. Now let's look at this uptrend. Here, look how we drew our trend line across the lows. So there are incorrect ways to draw trend lines. Why is this way incorrect? Well, remember, as long as the market is making new highs, you will draw your trend line across all the lows. In drawing your trend line, your outer upward trend line, you will start at the left of your chart and go across all the lows, moving from left to right. This is the correct way to draw your outer upward trend line across the lows. Let's look at this chart. This is the incorrect way to draw the trend line. At one time, this was the correct way, but look at how the market is achieving higher highs. We're still in an uptrend. The fact that we're still in an uptrend, this becomes the correct way. We start at the left of the chart and we draw it across all the lows. Now, this is the incorrect way to draw the trend line on this one. Why? Because the market is no longer making higher highs. It is now making lower lows and lower highs. Look at how this low is lower than that low, and that 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 high is lower than that high, and that high is lower than that high. This then is the correct way to draw this outer upward trend line. You start at the left, you bring it across the lows. Now that the market is making lower lows, you draw the trend line through the lows. We have now what's called a trend line break. Trend lines are invisible levels of support and resistance. Trend lines are projected locations where the market may bounce. Now here's an important notice. That is why we draw trend lines, because they are areas where the market is going to bounce and give us a trading opportunity. There are 3 primary trend lines we're going to focus in on. One is the inner trend line, 2 is the outer trend line, and 3 is a long-term trend line. And it is very important that a trader keep track of the inner, the outer, and the long-term trend line. Now, to establish the inner upward trend line, you will draw your trend line across the last 2 lows and extend it forward. So whenever you see a chart like this one, you will go to the current price and you will work backward from right to left. You will find your first low, then you will find your second low, and you will connect the 2 lines. You will then, from the second low back, start there, connected to the first low, and draw your trend line forward. This then becomes the inner upward trend line. The last two recent lows need to be connected with a line and the line drawn forward. Now we're going to go through a trading exercise, and what I'd like you to do is find the trend lines and draw them in your workbook. Here is the first chart. This chart has indicators on it, but find me the last two lows and draw the inner trend line. Pause your machine to do this exercise. This is what it should look like. Here's the answer to the inner upward trend line on this chart. Draw the inner upward trend line on this chart. Remember, you take your last two lows and you connect them. Pause your machine. Draw your inner upward trend line. This is what it should look like. You see this low right here? That has 2 to the left and 2 to the right. If you connected from here to here, you connected wrong, because this low right here, this wick low, is lower than that low. And that is no longer a level of support or a low. So what I should say as well is that you take your two last levels of support and draw your trend lines forward. The last two lows or levels of support, and draw your trend line forward. To establish the first upward outer trend line, you draw your outer upward trend line across all the lows or levels of support on your chart. So now you start to draw your outer upward trend line. You start at the left of the chart and you move forward, drawing your trend line across the lows or levels of support of your chart as long as the chart is making new highs. Now exercise 1. Draw the outer upward trend line across all these lows or levels of support. This is what it should look like. Here's another chart. Draw your outer upward trend line across all the lows on this chart. Pause your machine if you need to. This is what it should look like. Now find the long-term outer trend line. Look at a longer time frame. I've just taught you how to draw the inner trend line, now the outer trend line. Now we need to establish where is the long-term outer trend line. The first thing we're going to do is, on our first chart, we had an inner trend line drawn, the last two lows. Then we drew an outer trend line. This was across all the lows of the chart. And we are on a euro hourly chart. In order to find your long-term trend line, you need to go to a larger time period. Take it from 1 hour to 8 hours. Now, here then becomes the inner trend line, the outer trend line that was drawn on the previous chart. You can look at how on the previous charts, look at this previous chart, this takes on about a 10-day period of time, perhaps a week. Now look at this chart. We've gone into almost a entire month. We're now looking at a month picture. This is the inner trend line on this chart right there. This is the outer trend line over the week on this chart here. And this is the long-term outer. Once again, you'll draw your long-term outer just like you would on the outer trend line. You start at the lowest low on the chart, starting from the left, moving forward to the right across your levels of support. Find and draw the outer upward trend line on this chart. Pause your machine if you need to. This is what it would look like. There's your inner and outer trend line. Now, take that same chart. What I've done is I've taken that same chart and I've now put it into a 4-hour chart. Each candle represents 4 hours. Find and draw the inner, the outer, and the long term on this chart. Pause your machine if you need to. This is what it should look like. The last two lows for your inner, the outer became then over a 7-day period down here, and the long term brought on a month. I'm going to explain to you why this is very critical. You can see the market is still in an uptrend, making higher highs and higher lows. There are trends inside of trends. Keep that in mind. This is an important fact, an important trader's tip. Look at this chart. The market was trending down. Our indicator gave us a buy signal. It starts to trend up. It crowns, which is lesson King's crowns and reversals. Focus in on lesson 7. Is it 7 or 8? Lesson 8. Excuse me. Lesson 8 focuses in on King's crowns. It crowns, then it trends down. Look at how it waves down. It trends. And then it crowns again, and then it waves and starts to trend up. You have an uptrend, a downtrend, then an uptrend. But we have an overall uptrend. Look at how from the outer trend line you connected this one to this low to that low coming forward, and look at how the market bounced right at that trend line. Trend lines become invisible levels of support or resistance where the market can bounce. Now, this is a very important tip. When the inner trend line is broken, here's the inner trend line, the market has a tendency to work its way to the outer trend line. Now let's look at this. Look at how we drew an outer trend line at one time, and that spreads out, goes into the future. Look at how the market started to become aggressive, and it broke this inner trend line. And all it did was wave and go down to the outer trend line and bounce. These bounces are where we're going to teach you to enter the market and buy. The market bounces and then takes off and rallies at the outer trend line. We knew where this location was by connecting this low to this low to this low, drawn forward. See how it stays straight, and that's where the market bounced. It became the projected buy entry on a bounce. Now, trading the inner upward trend line. Whenever you connect your last two lows, what you want to do is you want to buy the bounce. So as this market retraces back, hits that trend line, we want to buy as it hits that trend line with a protective stop loss at the last low. Every time you buy, your stop order goes at the last low. Buy when the market hits the inner upward trend line with a protective stop loss order at the last low. So then this becomes our strategy. We now have connected the inner trend line here, the outer trend line there. When the market retraces and hits this trend line, we will buy with a protective stop loss order at the last low if equity management allows. Now trading the outer trend line. As the market is waving and we have the big outer trend line, we will buy when the market hits the outer trend line with a protective stop loss order at the last low. Here then becomes the strategy. This is the outer trend line. As the market comes down and hits this trend line right here, we will buy with a protective stop loss order at the last low. For profit taking, please review lesson 7, which is price swings and Fibonacci's. The market moves in a natural, harmonic, vibratory sequence. It tells you the reason why the market stops here and why it stops there and why it stopped there and why it came back and why it stops there. It's an amazing lesson. Now, sometimes the inner and outer trend lines merge and can create a convergence. Whenever you have an outer and an inner converging, that becomes even a better place to bounce because you have two reasons why the market's going to bounce. Now let's walk through a trading exercise. We are on slide number 87. Let's face the facts. Every trader wants the market to move in their direction from entry. Education on how the market works improves those percentages. Let's watch what education on trends and trend lines can do. Now here's the rules to trading a trend. Number one, find and draw all your trend lines, your inner, your outer, and long term. This will help you to determine if you are in an uptrend, a downtrend, or if a trend line has been broken, signifying a potential end of a trend. Find the anticipated trend line bounce. Find where the last level of support is in an uptrend or resistance in a downtrend to determine where your protective stop loss orders are. Don't forget lesson 2, the financial game between bulls and bears. It's a great lesson that teaches you that the bulls and bears have clear objectives. If you can't afford the potential loss and your protective stop loss is too far away, then stay out and don't trade. Go find another trading opportunity with another product. Pull out your trader's checklist and create a trading plan. Every lesson has a trader's checklist at the back of the lesson. Pull that out and abide by it. Now turn on your trading software. Market Traders, ForexTips.com has created a piece of trading software that can help you practice trade. We give you $50,000 of monopoly money that allow you to trade. This is a state-of-the-art software. It constantly shows you the bid and the ask of a product. This is the Japanese yen. Here's the bid and the ask from all these different products here. This is a currency cross. Whenever you trade the Australian dollar against the Canadian dollar, that is the Australian-Canadian cross. The Australian dollar traded against the Japanese yen is the Australian-Japanese cross. The Australian dollar traded against the US dollar is called the Australian US dollar cross. Now, I also like everybody to keep a written track record of everything that they do. In the back of your lesson, there are these trading forms. You can see that it's only a half of a page. The reason why is after you execute a trade, print out the chart at the top of the page. Place your date, the stock or currency you're trading. We are going to be trading an uptrend. Circle that. The instructions on how to fill this out are also at the back of your work manual. Keep a written record of everything that you do, so that just in case your computer crashes or your electricity goes out for whatever reason, you have a written record. If there's a discrepancy between you and your broker, you have a written record of what you've done. Keep in mind that all conversations are recorded with your broker. The verbal commitments with your broker become the law. We turn on our computer and this is what we see. So now the first thing we want to do is start drawing trend lines. Well, we draw a downward trend line, which we're going to discuss on how to do that. We see that it's been broken. Look at how the market was making lower lows and lower highs, but now it broke a trend line and now it's making higher highs and higher lows. So we now have to create an upward trend line. Now that we have an upward trend line, this really becomes our inner and our outer trend line. This is a 2-hour chart. You can take this down to a 1-hour chart and a 30-minute chart and even get a better view. I like to find trades on 2- and 4-hour charts and then focus in on my entries on a 30-minute chart. We now have an outer trend line right here. This is the outer downward trend line. This is the outer upward trend line. Now our strategy is going to be to buy when the market comes down and hits the outer trend line. So whenever the market hits that trend line, we're going to move to this section of your trading form. We are going to put a buy here. Now remember, every buy needs to have two sells, so you'll place your buy here. This will be your sell for profit. This will be your sell for loss. These columns are where you put the numbers. So whatever number we enter at and however many pip our stop is right there and what our profit is. We will put an arrow pointing up in this column. That will help us remember that we are buying and we want the market to go up, and this will become our stop order. That is what that stands for, stop and limit order. Please find all your levels of support and resistance before you trade. This section is for beats. The market moves in a harmonic beat fashion. That is lesson 14. It's an invaluable lesson. These are all the different lessons that we have that teach morning stars, evening stars, beats, crowns, Gartleys, convergences, indicators. There's a tremendous amount of potential in learning how to trade. Now remember, if you're buying, your protective stop loss order must be at the last low or the latest level of support. So here's all our levels of resistance. Here's our levels of support. And if we buy now, because now look at how the market has come back down and hit our trend line. We are going to buy right now with a protective stop loss order right here at the last level of support. This lends itself to equity management. We're only looking at about a 30 pip stop. So when you buy, you would, on your software, you would literally go in, you'd find out what that level is. Let's just say that's 85.50. So that's where you would be buying at 85.50. Your stop order would be at about 85.30. This lends itself to a tight stop. Remember in lesson 2 where we talked about financial stops, if the swings are small, put your stop order a little beyond the last low as to stay away from the bid-ask chart. So you may want to go about 5 pips beyond this low, maybe 7 pips, to stay away from being stopped out prematurely. When the swings are small, many times the market can kind of move sideways a little bit before it takes off. But we're going to anticipate a trend line bounce here, and we're entering the market buying with a stop order at the last low. Now the market hits the trend line, starts to go through it. Here was our stop order. You can see it came very close. It came back down about 88% of this swing. The lesson on Fibonacci's teaches you all about that. But then look at how it just bounced and took off. A great payoff. The market bounces at trend lines, and it is a great place to enter. Go to your software. Your software keeps track of the P&L statement on the bottom. But more importantly, go back to your paperwork and fill out what price you bought it at, what price you sold it at, figure out how many pips you made, how much money per pip you made, what the amount was. Obviously, you were trading 1,000 lots. Every time you're successful, you trade 1,000 lots, correct? When you're unsuccessful, you only traded 1 lot. No, as a beginner trader, you will be trading 1 lot at a time, become proficient at what you're doing, and then figure out this P&L statement. Now, downtrend price swings, they work the opposite. They work identical, but in the opposite direction. A downtrend price swing starts at a high and works its way down to a low. Look at how it started at a high and worked its way down to low. That is called a downtrend price swing. Now, downtrends are when the market is making lower lows. See how this low is lower than that low? And lower highs. See how this high is lower than that high? Let's look at this chart. This is a downtrend making lower lows and lower highs. This is a downtrend using indicators. Now, once again, look how valuable this indicator is. This gave a sell signal right here. Look at the market dropped literally 1,000 pips from this sell signal. Learning to cancel replace. You would cancel from your entry, cancel replace, cancel replace, cancel replace, cancel replace, cancel replace, cancel replace, locking in profit. People like to trade the currency market because it moves 1,000 pips at a time, sometimes 2,000 pips at a time in a direction. Downtrend is lower lows and lower highs. When you spot a downtrend, you will draw your trend line across the highs. Across the highs. Look at this trend line. See how we go across the highs? Now, this is an incorrect way to draw a trend line. Look at how we went through the candles here across these highs. That is not how you draw an outer downward trend line. You've got to go across the highs. Remember, as long as lower lows are being created, you must draw the downward trend line across the highs. This is the correct way. See how we had it here first? Now we moved it to all the highs. We're going to learn via an exercise how to draw your trend lines. This is another incorrect way. The market is still making lower lows and lower highs. Therefore, you go across all the highs. This is an incorrect way. We're still making lower lows and lower highs. Start at the left and go across all the highs. Now, trend lines, once again, are invisible levels of support and resistance, and that's where the market is going to bounce. We want to find potential areas in the future where the market's going to bounce. Those make great entries that allows the market to move our direction from time of entry. There are primarily 3 downward trend lines forming in any trend: an inner, an outer, and a long-term trend line. So, as I said, it works the same in a downtrend. Let's find the inner downward trend line. You will draw your trend line across the last 2 highs or level of resistance. Now let's look at this chart. This chart, that's where the current market is. I go and find my first high or level of resistance and connect it with my previous high or level of resistance. And I connect those two. I start at the right of the chart, moving backwards to the left. I connect those two and draw it forward. Now let's go through this trading exercise. You find the inner downward trend line on these charts. Pause your machine and find the inner downward trend line. This is what it should look like. I've connected my last 2 highs. Now what will happen is, as this market retraces back, I'm going to short the market right here with a stop at the last low. Now draw the inner downward trend line on this chart. Pause your machine. This is what it should look like. That is the last high connected to the previous high, which are your last 2 levels of resistance. Draw the inner downward trend line on this one. Pause your machine. This is what it should look like. Now, if you drew your trend line from here to here, you drew it wrong. The market is reversing. We were making lower lows and lower highs. This is where a lot of traders get confused. We now are no longer making lower lows and lower highs. Look at how the market has come up to the last level of resistance. To avoid this problem, you really need to focus in on what's called the King's Crown and the reversal. This is lesson 8. So lesson 8 focuses in on teaching you why and how to spot this reversal. So to establish the outer downward trend line, you will start at the left of your chart and draw it across all the highs going forward. So on this one, draw the outer downward trend line. Remember, find the highest high to the left and now come across all your levels of resistance coming down. Pause your machine. This is what it should look like. Now draw your outer downward trend line on this one. The market is still making lower lows and lower highs, so start at the left, go across your latest levels of resistance or your highs. That is what it should look like. Draw the outer downward trend line on this chart. Pause your machine. This is what it should look like. Now, to find the long-term outer trend line, look at a longer time frame. Remember, we've done the inner, which is connecting the last two levels, the current levels of resistance. Then we go to a larger time frame or across the chart, and we start from the left to the right. Now we have to move from like a 1 hour time frame to perhaps a 4 or 8 hour time frame. Here's a 2 hour time frame, and what I want you to do is I'd like you to draw the outer downward trend line on this one and the inner. That's what it should look like. Now what we need to do is we need to go from a 2 hour to an 8 hour on the same chart. Now look back at this one. This was from August 15th through the 21st, and that was for the inner. Then we went from August 5th to August 21st, almost 3 weeks for the outer. Now what we need to do is we have gone to an 8 hour, which is June 13th all the way through August 21st, which is really 2.5 months or 2 months. And now we need to find the outer trend line. So now find and draw the inner, outer, and long-term downward trend line. Pause your machine. This is what it should look like. See, here's the inner, here's the outer, and here's the long-term. These areas are where we're going to sell. If it breaks this trend line, we're going to sell here. If it breaks this trend line, we're going to sell here. Now, remember, when the market breaks a trend line, it usually works its way to the other trend line. If it breaks an inner, it's going to the outer. If it breaks the outer, it's going to the long-term outer. So what is taking place in this chart is the market broke the inner trend line, and it's slowly working its way to the outer trend line. We will anticipate shorting the market when it smacks this outer trend line. This is also now what's called the buy zone. The buy zone is lesson 6. It's a great tool, learning buy and sell zones. Trading the inner downward trend line. Now, once again, we are going to sell when the market hits the inner trend line with a protective stop loss order at the last high. So if this is the inner downward trend line, when the market rallies back up here, hits the inner downward trend line, we will sell it if equity management allows us. This is Microsoft. We will place our stop at the last high if you were going to short the market, perhaps with some options. Protective stop loss orders go at the last high. Trading outer or long-term downward trend lines. Once again, you draw your trend line across starting from the left to the right. When the market comes back up, hits the outer downward trend line, and we're going to short it with a protective stop loss high at the last high. Look at this chart. Market rallies. Our plan is to sell when the market hits this trend line with a protective stop loss order at the last high. Sometimes the inner and the outer trend lines merge and create a convergence. If you can find an inner and an outer merging, that's a double reason why the market will bounce. We will then short the market when it hits those two locations. Look at this one. The outer trend line is merging with the inner trend line, and obviously you have a outer long-term trend line way up here. But these two are just going side by side, which means now would be a good time to short this if equity management allows with your trade at the last high. Now let's go through a trading exercise. Let's trade a downtrend. Let's face the facts. Once again, every trader wants the market to move in their direction. Look what education is doing for us. We are educating ourselves about a downtrend, and that should improve our percentages of success. Rules to trading a downtrend are exactly the same as the rules to trading an uptrend. We're going to draw all our trend lines to find our inner, outer, long-term trend lines. This will help you determine whether or not we're in an uptrend or a downtrend. We are going to find and anticipate a trend line bounce. We're going to find where all our levels of support and resistance are. That will tell us where our stop will need to go and keep us in tune with the financial gain that exists in the market. We will look at our equity management. If we can't afford to trade it, we will stay out and not trade, and we'll pull out our trader's checklist and go through our checklist before we trade. Once again, you'll turn on your trading software. You'll fill out your paperwork. We're trading a downtrend now, not an uptrend, and we'll go place our date and this type of currency we're trading. You tell me, what do you see? Fill this out yourself. What trend lines do you see? Pause your machine. Well, this is what I see. I see that we are in an uptrend overall, but that the inner upward trend line has been broken. And what is the rule? When the inner upward trend line has been broken, the market will usually move to the outer trend line. So what I am anticipating is, now that the inner upward trend line has been broken, I am starting to see a wave. And I also see a crown forming, which is less than 8. And so now I see a downward trend line. So I need to now draw my downward trend line. And so now that the market is reversing, now if I was to throw on some indicators here, I may get a crossover, and see, now I'd be using an indicator along with the fact that the market is now reversing via the trend lines. I've now drawn a downward trend line. My plan now is to sell when the market rallies and hits this downward trend line. That then becomes the plan. I'm going to sell when the market hits that downward trend line with my protective stop loss at the last high. I will fill out my paperwork. I'll put now a sell. Every sell has 2 buys. I'll put my prices here. My arrow will go down. This then becomes my stop order. This then becomes my limit order for profit. If you are selling, your protective stop loss orders must be at the last high. Therefore, now that the market has rallied and hit the trend line, I'm going to get in the market with a protective stop loss order at the last high. Look at this again. Lends itself to a nice tight stop. If I short the market here, my protective stop will be there. I can trade this several different ways. Remember, the outer trend line was way down here. I can anticipate this moving all the way down to the outer trend line. You may want to review lesson 16, which is on trading strategies. There are several strategies you can do this with. You can enter with 2 lots and quickly sell one before it takes out the low, which is the game, lesson 2. Or you can enter with several lots and sell them as it starts to fall. Understanding your Fibonacci's will tell you where the next bounce is down here. Be that as it may, the game in lesson 2 of the bulls and the bears, if they maintain control and don't break this trend line, and the bulls don't break this trend line, chances are the market's going to take out this low, this low, this low. These become milestones for the market to achieve. So either way, I'm selling right now with a stop at the last high. Look at how the market bounced right at my entry, formed a beautiful evening star, which is less than 18 on candlesticks, and then just fell. Obviously, the market working its way to the outer trend line. But look at, if I canceled and replaced, look at all the profit I'm locking in. Market fell well over 100 pips. Risk and reward, look at how I risked very little for a huge reward. Once again, your software will give you your P&L statement, but figure it out on your paperwork. Sell, place what you sold it for, your buy, how many pips you gained. Spotting the end of a trend, that is lesson 8. Remember, not all trends that go up go to the moon. They come back down, and as they come back down, they bounce and trend down. A trend is your friend until it bends. So look at how the market has now started to reverse and the outer trend line has bent. The same appears on a downtrend. The trend is your friend until it bends. The downtrend ends when it breaks the trend line and reaches its last level of resistance. Look at this one. The market was in a downtrend. It bent. It came up now to the last level of resistance. It is now reversed and is starting to climb. Look at how this indicator participates in telling you that this is the end of a downtrend. It is now reversing. If you want to know what to do at the end of a trend, you must purchase and review lesson 6, trading buy and sell zones, and lesson 8, the King's Crown, the end of a trend. Well worth the investment of time and money. Now remember, the best way to understand what you have learned is to write down what you think you know, then go back after you have been taught and look at what you thought you knew versus what you now know. Remember, your perception is your reality. Hopefully you now have a new perception of how to draw trend lines. This was the first chart. This is a Swiss franc. This is what it should look like now. That is the outer trend line. This is the outer trend line has been broken. Here's a Japanese yen 4-hour chart. It's still in an uptrend. This would be the outer trend line, and inner trend line would be these last two going up. Here's the euro. This is what the euro should look like. Here's the euro outer trend line. Here's the euro inner trend line. It has bent. We are now working our way to the outer trend line. The next anticipated buy would be drawing a trend line coming across these lows and shorting it when it hits this trend line there. Here's Microsoft. This is what it looks like. Trend line bounces. These are your trading opportunities to short. Here's Dell stock. If you were going to be doing puts and calls, you could decide that, gee, you know, this is still in a downward trend line. The valuable part about learning your trend lines is this. If anybody comes along and says, hey, I've got a hot tip for you, go buy this stock. And if you, now that you've been educated about trend lines and you pull up a chart on that stock, if it's still in a downtrend, why would you want to buy it? You wouldn't. You just keep following that trend line, and then after it breaks the trend line, then's when you want to perhaps purchase that stock. What if this continues to fall? What if Dell stock continues to fall from 30 all the way down to $10, and somebody says, hey, there's a hot tip, and he buys it at 30, but you followed the downtrend line all the way till it finally breaks the trend line at $10. All of a sudden you could go back to your buddy and say, hey, look it, I bought Dell at $10 instead of $30, and it was all based on your education. Trading the inner upward trend lines, remember, we're trying to buy when it hits the trend line. On an outer, you want to buy when it hits the trend line. When you're selling, you want to sell when it hits that inner trend line. You want to sell when it hits that outer trend line. Keep in mind, when the trend lines end up breaking, they end up going to the next trend line. So it gives, they enter into what's called the buy or sell zone, lesson 6. So here's the rules. Remember, we printed out in your workbook all the rules for trading a trend. Let's all agree. If you're going to be a successful trader, you've got to have an edge. You need to educate yourself on where to get in and understand the why behind it, and where to get out and understand the why behind it. You need to manage your risk and lock in profit along the way. Did this lesson teach you how to find a high and a low, how to find support and resistance, how to draw an inner, outer, and long-term trend line in an up and down trend? Did this lesson teach you how to place an order at a trend line? Did this lesson teach you that a trend is your friend until it bends, and where to place your protective stop-loss orders and financially protect yourself in every trade? If it did not, go back and replay this lesson, because the reality of trading is 90% fail and only 10% succeed. The 10% that succeed usually are people that have taken the time to properly educate themselves. See, successful people and traders will do what unsuccessful people won't do. There's two ways you can pay for your education. One is luck, and if you make money from trading and you don't know what you're doing, you just got lucky, and it'll only be a matter of time until you get unlucky and lose everything you started with. If you have to be told where to get in, you'll have to be told where to get out. That's a very vulnerable feeling. I don't like that feeling. There are two ways to pay for your education. Once again, the second way is mentorship. Working with a mentor and getting an education on how the market works. Market Traders and ForexTips.com, we're mentors. We teach people how to trade. Learning from a mentor is like buying a map to a gold mine. You learn where to get in and why, and you learn where to get out and why. So don't try to get lucky. Buy that map. Understand how to extract the gold from the mountain, and understand how to extract it in safety with proper education. Every trader wants the market to move in their direction from entry. Education on how the market works improves those percentages. We have 16 lessons that can participate greatly on teaching you how to trade the Forex, as well as understand how to trade technical analysis. This lesson on trends, these trend lines are applicable on all charts: stock charts, equity charts, securities, bonds, commodities. It doesn't matter. These lessons come with a trading exercise. Every trader should have a trading mantra. The mantra needs to go like this: I will educate myself on how the market works. I will learn how to find and place a trade. I will trade with equity management. I will never trade without a protective stop loss order. I will not chase the market. I will be patient. And if the market does not meet the criteria of my trade, I will not trade. This is a discipline. You have to acquire this discipline. And remember, if the chart is not clear and doesn't visually make sense, when in doubt, stay out. Because of this rule, the 21-day 3% rule, look at, you have just received a lesson on trends and trend lines. If you don't review this over and over and over again, after 3 days, you're going to lose 80% of all these traders' tips that I've given you that can participate greatly in helping you become successful. If you don't use it, you lose it. So go back and replay this until it becomes part of your trading technique and style. And on behalf of everybody at Market Traders Institute Incorporated and ForexTips.com Incorporated, we'd like to say thank you for investing in yourself, and your family would like to say thank you for educating yourself before you invest your hard-earned money.